Glass, I think he said the glass is not half full, it's a 3/4 full. But we need to explain what pushed this quarter to 3/4.
One angle, maybe what's going to be the impact of this on the Nairobi Securities Exchange? We are alive to the fact that about 30% or so of external flight,
we'll come to that. We'll come to that. Just squarely look at what will be happening at the Nairobi Security Exchange. Let's follow us on this on the shilling.
I want to create something which is quite important from an economic perspective: speculation. Like, people realize that the dollar is losing. The temptation is I put the dollar to the market before it goes to a lower level. So people start saying, "Oh, the dollar is at 156. I want to go there before it is 140," and that could also play a part in making the shilling stronger.
Stabilize.
Is that people are speculating it will become weaker, so they take the dollar to the market, and that has a momentum in the market.
I suspect Shem is the one who's actually lost that 100,000 shillings.
Or gained by the way.
You see, the dollar might become weak. So you won't take it to the market before it becomes even weaker.
It's always good to have ears on the ground.
Hedging decisions are important by the very rich. You can decide to invest it in a project that will give you a high return, or you can simply build up your reserves of hard currency. So you get out of the shilling economy, so to say. You're a Kenyan, you have some resources, but you want to hold on to hard currency because your projection is over time. I will not suffer the losses I can see for sure if I stay in the shilling. But I'll probably make a gain that I can see in dealing in hard currencies. There was a time when they were saying that private individuals' foreign reserves, far exceeded the state ones.
That's true.
So that's analogous to the examples that my colleagues have given around the table on gold in India, for example, where you begin now persuading the Indian grandmothers with their valuable chains and anybody else keeping gold things to bring it in with some promise of an attractive return and that kind of thing. In India, it's still, there's more gold with the people than there is with the official reserves. So it's a cushion in the system, so to say, but it's out of the monetary system. It is deep in the cultural domain. If you can induce them to monetize that a little bit and bring it in, it helps you. But here also we do get people, the reason we get things like the Panama reserves and so on, we look at it as an ugly political thing. No, but it's also a smart commercial move. You exit the shilling, you hold a reserve somewhere. These are monies that you may have gained simply by buying from the market when the dollar was available. Let's use the dollar to mean for hard currency. When the dollar was liberally available, people make those decisions to accumulate those reserves and put back at the right moment. And if that right moment doesn't come when the country needs it, but they don't need it, then you do get this artificiality, some of this artificiality that you talked about.
All right, thank you. All right, let's look at how the cost of business is doing as well, where we have the business community citing the cost of doing business as a major stumbling block to the sustainability of the firms. This was noted during the third Sustainability Forum by Diamond Trust Bank, where it was acknowledged that the country, especially in the tea sector, is losing a lot of opportunities in respect of value addition as the country exports these opportunities.
Firms do not operate in a vacuum. We operate in the environment. So the environment that we work in is going to decide also for you whether your ability to scale, more or less to what he's talking about. If cost of finance, interest rates, availability of raw materials, capacity, all that is unavailable from that level, it becomes very, very difficult for a business to survive.
In terms of timing, we believe that as businesses continue to navigate, there is also a need for us as businesses to reinvent. And as a bank which partners with our customers and the business community, broadly speaking, we believe that we need to provide that environment so that we remodel our businesses as we take advantage of emerging opportunities and navigate ourselves out of past risks and vulnerabilities.
Now, last week's move by Central Bank of Kenya to raise borrowing costs to a 12-year high of 13% has further damped trading activity on the Nairobi Security Exchange. with analysts warning that the trend will prolong as investors shifted to fixed income assets. On Wednesday, just a day after the Apex Bank's announcement, the Nairobi bourse had, of course, a recorded dash of 9.8 billion shillings paper wealth loss to close at a market cap of 1.435 trillion shillings, down from 1.445 trillion on Tuesday. By close of trading, of course, yesterday, that is on Tuesday, I should say, the total valuation of equities stood at 1.429, of course, representing 16 billion shillings loss from representing 16 billion shillings loss from the rate review a week ago. The NSE All Share Index also closed, that was the day before yesterday, trading down at a point from Tuesday last week, with NSE 20 Index retreating by 4 points over the 1 week. Also last week, foreign investors pulled out 63.2 million shillings from the NSE, extending the previous week's trend. Of course, they remained net sellers, marking 101.8 million shillings in net portfolio outflows. Over the 1 week period to, of course, yesterday, large cap stocks, including Safaricom, KCB, and equity banks, recorded a bearish trend as their respective share prices posted 5-day percentage changes, shedding 1.86%. And we just want to now put that into perspective as well. You wanted to talk about the Nairobi Security Exchange, and of course, raising the 13% interest rate by CBK. We can see the blowback. Now people are moving towards a fixed income assets as it is right now.
Debal, maybe first, the figure I saw there of 6.3 million being moved out last week, probably that could be billion, I don't know.
Billion shillings.
I suspect, but I could be wrong. But Debal, yes, it's true that the stock exchange has seen plight of quite a bit of assets in the past 3 or so months. My hope was that with a strengthened shilling, we could start seeing back inflow, that resource coming back. People who invest, of course, at the stock exchange do so because they want to make profit, sell when high and buy when low. So that's expected to happen. But over the weekend, we had a webinar together with Nairobi Stock Exchange. Chairman Kiptonyi was our keynote speaker, and the PS of Investment Development was our chief guest. And Debal, together with Strathmore Business School and a licensed Moran Capital experts, advisors in the stock market, and also Capital Markets Authority were present. The idea was they were pitching to the diasporas on what are the safe and secure ways to invest in Kenya. In fact, I must admit, the webinar maxed out, meaning Kenyans, both within the country and outside, are thirsty. There's a lot of information that's not available to them. But Debal, in particular, in terms of balancing the value of assets, nobody wants to put their money in the stock market and go at a loss. I think even the wealthy people, they always want to create more wealth out of what they have. So Debal, my thinking is that it's good the Kenya shilling is strengthening. I would want to make an appeal to the diasporas that I know they're already sending quite significant amounts of money at home. Home is home, east, west, home is best. So even in hard times, let them pump more of their resources back home to cushion our economy. But above all else, I also want to encourage the government to come up with incentives that let them bring in more. They're only bringing about 5 or 10% of the capacity from the information we have. Even if we just made them double it, we would be talking of 1 trillion shillings coming into our economy every year without a lot of sweat. So Debal, I commend Nairobi Securities Exchange. Together with Capital Markets Authority, I think they're also coming up with additional new products, giving investors and business people options, including unlisted products. I think, finally, let me say that I was glad to see the East African Business Exchange also coming into play. If we think of the bigger market, East Africa, beyond Kenya, I'm so happy. I was having a conversation with an advisor in President Museveni's office. In April, we're having a meeting to celebrate the Global Africa Diasporas in Kampala. I think they were saying, look, it would be so nice if we are able to buy from Kampala Stock Exchange, Johannesburg Stock Exchange, and trade among ourselves. Hopefully people make money when they trade across those exchanges and bring them into one. It would be so nice to have an African exchange hosted in Nairobi. And I'm hoping that's an area KDCs and others are looking at.
All right, so we can see the impact of the rates, despite the fact that we have diversified portfolios still.
Right.
But the flash of interest also is taking a glacial slowness. People are not really picking up these products very quickly. I don't know. It seems it's still buffering or it's still loading.
Let me give my senior chance first. Then I
wanted to pick something before we forget. I'm not quite sure any security market is a good barometer of what's happening in a country. And it's true, people want really to invest so you can get something. I don't see the reaction of NSC to whatever we're talking about. But Flora here talked a very interesting thing, and this is the bulk of it. The cost of doing business is expensive. I was talking with a manufacturer on Sunday, and he said, I can't manufacture anymore. I'm thinking of moving. Because when you look at that, you have the power bill, right? Well, a friend of mine was saying he's paying what, 40,000, and it's just a family. Paying 18,000. You can imagine the manufacturers. And that's why Baburi are going the way they are going. Mm-hmm. You look at, you have to pay now, housing levy, whatever, of all these people. So it becomes very expensive to do business. And the fundamental, from my perspective, as you talked about inflows in UAE, it could either be product or services. If we can't address the issue of doing business, then you don't expect production at all. Mm-hmm. So I don't know what to call it, Ilaki. I'm looking for a term to say this dollar, the Kenya shilling having an edge of the dollar. I don't know what to call it.
I have a name.
Suspicious kind of behavior.
I have a name if you arouse me.
Give the name.
I've just seen somebody online saying that the reason why the sharing is doing very well is so that we can be very happy. So when shift comes in March 1, we cannot remember that we are supposed to pay more revenue around March the 1st. That's what somebody is saying. But if you, in a businessman, I agree with you. It's paying more taxes, paying the levies, and the interests have gone up. So if you are going to borrow money from the bank for development, for anything, the price have gone up, or the interest has gone up. So the businessman, the most logical way to reduce your cost is to reduce your staff, because that's the most dispensable part of your capital.
And the first thing to do anyway.
Because you cannot remove a machine and throw it away. But human beings, you tell them, don't come tomorrow. So I think business people are I think their complaint is not empty. They are suffering. But we're also forgetting another very important suffering, the emotional suffering. People are stressed, people are unhappy. People don't know about the next policy shift. Mm-hmm. And people are not sure about the expectations. And we should actually be more worried, not about the people who are saying they are crossing or they have crossed, but the people who are keeping quiet and doing nothing about it. Or people are so stressed they can't do anything about it. So I think we are seeing the tip of the iceberg. Let's find out what is happening below the iceberg. Mm-hmm. So if you look at the headlines, look at what is in the Standard, look at what is in the Business Daily. It tells you how people are emotionally stressed. And that has an effect on our productivity and economic performance, beyond the hard data that we get from NSC or from National Bureau of Statistics. Mm-hmm.
Right. Waking up to such depressing news of laying off 15% of staff on a tough economy. And this is what CBK is saying. Does in any way the rates increase could have also affected the performance of a shilling? On a layman terms,
yes. Which rate?
Of the CBK rate to 13 from 13. I think the highest in 10 years.
Yes. Yeah. The only thing is that these CBK rate movements many times are more related to the management of inflation than anything in it. And what the business sector, I'm sure, would be looking at, they can see beyond that particular step. We have moved to 13 what's the long time in this case, maybe a year, several months sort of thing, expectation. What's the game plan here? What are they trying to achieve? So they will be looking beyond that. It's trying to contain inflation. They will be looking at the near-term projections on inflation, whether it's expected to be going down or not. It's expected to be going down. They will base their decisions on what they see happening maybe in 3 months' time, in 6 months' time, rather than what will happen only next week. That is for those who have cash reserves and want to move them, for example, if they feel affected or if it's a threat to them. Plus also, Debal, when something good happens with the stock exchange, monies will move from elsewhere to the stock exchange. You will sell your other assets, move them. If the returns on, let's say, real estate were really that good, monies will tend to move there. If they discover huge reserves of available gold in Kakamega and so on, people will put it in the mining sector, for example, and so on. So those movements are expected to occur. And, one loses, the other gains, but it's also related to people trying to hang on to the value of their assets at any one time. So, excuse me. But now, going back also now to this issue of the cost of doing business, Kenya has been doing well on the ease of doing business. As you'll all agree, they rate themselves, they have been rated rather by studies done by institutions like the World Bank and others as improving substantially. But that on the cost, this I find this a little
perplexing, yeah.
Perplexing.
Yeah.
But the cost of doing business, businessmen are complaining that it is high. It reminds me, and I'm glad that this to professors who are here now, in the old studies around interest rates and credit and so on, the argument was that it's not the level of interest rate that worries many people. It's access to it that we're being told that access to money is so difficult, to credit, for example, so difficult that if you made that easy, even if it was at a higher cost but easy to access, business people and other households would prefer that, so that the ease of accessing was the more important thing rather than the cost of doing it. It's two sides of the same coin, but you have to switch your mindset a little bit to think through this. So we have done well on the ease of doing business, and we continue, I'm sure, to improve, but we are not doing so well on the cost of doing business. So maybe it is now time that we begin to look at that. And people are saying, but you government are also part of the problem. Look at how many licenses you need. Look at how long NEMA takes and what it costs and so on. That now the ball game may be in your corner as well. So you did well on the ease, but the cost is still a contributor. So I think it's just a right refocus on another side of the same problem. And if we ease off on the cost also, and we are doing well on the ease of doing business, overall we should improve our position.
Debal?
May I add something?
Yeah, sure. I think for me there are just 2 points to add. I fully agree with the chairman on concerns about cost of doing business. If I remember correctly, I think it was President Ronald Reagan who said for America it was economy stupid.
Bill Clinton.
Bill Clinton. Right. I think for me, for Kenya, it's manufacturing stupid. Unless and until we can do more manufacturing and export, I think we're not going to get out of these doldrums. But how do we get more manufacturing and more production? Obviously, the cost of doing business, including the costs that go to the manufacturers, have to be reviewed. In terms of the layoff, maybe one aspect, of course, is the interest rates and the high cost of business, the high cost of living as well. But perhaps, to what extent is automation playing a role here? Because this is likely to get worse. The more companies automate, and I think Kenyans need to be alerted that they need to reorientate and retrain and untrain and learn and relearn so that they prepare for the future of work, because we are going to see a lot more mechanization in what happens. So in this 15%, I wouldn't say, maybe somebody needs to look at to what extent is automation also playing a role.
There's a very important factor for a manufacturer looking for the cost of power.
Right.
It's interesting, you look at Ethiopia. Ethiopia has the 3rd lowest price of power in the world. Right. third lowest in the world, Ethiopia. How do they manage that?
We build our Renaissance Dam.
Right.
Yeah.
They have not even finished the Renaissance Dam, but it's still whatever they have.
Right.
They're the third cheapest, and that's why it's cheaper. And producers or manufacturers will produce. I'm not sure about what you meant by manufacturing stupid.
That's where the focus should be.
Yeah.
I'm enjoying the conversation between the two profs. I like Honorable Bunyasi's comment about access to credit. And if you look at Kenya, some of the people doing very well happens to be Shyrox and online lending platforms. Very expensive, but very accessible. And maybe that's what we should borrow from banks and so on. Now, I want to address your question, which I found very perplexing, whether the rise in interest rates had an effect on the strengthening of the Kenyan sharing.
Yes.
And I like that question because it actually makes the appreciation of the Kenyan sharing more mysterious. when the interest rate went up by 200 basis points, 2%, we didn't see that dip. We didn't see that appreciation of the Kenyan sharing. But it went up by 0.5, we saw the sharing appreciate from about 160 to about
153.
Which makes it wonder why should we have a bigger effect from 0.5 than 2%? And that's why I'm still saying we need something. We need more explanation why the sharing is appreciating.
Indeed. All right. Let's just move on and see. We're talking about now the deficit, which is falling also precipitously, where Kenya's imports of machinery, fuel, and raw materials dropped by double-digit rates last year for the first time since the peak of the COVID-19 pandemic linked, of course, shutdowns 3 years ago, signaling a slowdown in production activities in key sectors such as manufacturing and construction. The value of goods ordered from abroad dropped 10.61% to nearly $17.2 billion. That is 2.74 trillion shillings under prevailing dollar conversion rates compared with the year before. According to the provisional data from the Central Bank of Kenya and the Kenya Revenue Authority, reduced imports amid a surprise decline in earnings from exports cut the gap between the exports and imports by 15.94%, or nearly $1.87 billion. It marked the first full-year contraction since 2020, when the movement of goods from the main source markets such as China was largely curtailed by global lockdowns and shutdowns to curb the spread of coronavirus. Total exports in the review period dropped a marginal 2.2% to $7.26 billion, or 1.16 trillion shillings. The data shows going against CBK's earlier projections of a 6.7% growth, a faster growth in expenditure on shipments from foreign countries than earnings from exports narrowed the goods trade deficit to $9.85 billion. That is from $11.72 billion in 2023. Kenya has over the years struggled to narrow its goods trade deficit, partly due to reliance on traditional farm produce exports such as tea, horticulture and coffee, which are largely sold raw, fetching relatively lower earnings. And we want just now to look at this as well. We saw the Ministry of Agriculture, led by CS Mithika Linturi, pumping almost 100 billion shillings into the agricultural sector, saying that we want to boost that particular sector. But even if we go that way, we've always questioned why agriculture contributes almost 3% to the GDP. That in terms of tax revenue, it is way below what actually it contributes to the GDP. Let's just talk about this declining trade deficit and what also product portfolios we do have.
Okay. So I missed the highlight of the issue, but so my answer
what have you missed? It's just the declining deficit, and in light of where we are.
But
right
the critical
now,
point
yes.
you wanted me to comment on. But let me just say something that's, I think, broadly related, and then maybe with my colleagues' help we can pin down. Agriculture in our economy underpins many products. In many ways, they fall back to an agro-based system. And even our industrial production, a lot of it is agriculture-based, except a little bit that is probably on minerals and so on. So it is something that I think is pervasive, and therefore the impact of additional inflows will not be measured in outputs that are specific to agriculture, but in output that may be generally on the economy. So, but I may not go too far so that I don't take the discussion maybe out of context that you narrowly wanted, yeah.
Yeah, but also just looking at, okay, let me just pick your points first of all, then we can try and see this trade deficit, especially with the manufacturing sector.
Right.
Cost of doing business. We can add on to it because even the machinery now, they're not importing these machineries.
Not as much.
Yeah, their products as well. And how will that adversely affect the entire sector?
Okay.
We've seen also manufacturing sector, they're defaulting on loans.
Right.
This has not really happened in many years, but now.
Which is very telling because of the imports. If you look at the machinery, as you're right, look, we're talking China taking the bigger rayon, 50%. We're talking of oil, Emirates and all that. We're talking of India. I'm not sure what we are exporting from India.
Machinery as well.
From India.
Pharmaceuticals.
And the fourth one is actually Saudi. So you can understand Saudi and the other because of the oil. But very interesting, we at the same time, these are the export countries, or we are stuck with our traditional EU, and we are not exporting as much.
Yeah, Iraqi.
So I get concerned, any economist would celebrate that the deficit is narrowing. But it is narrowing because we are importing less, and we should be questioning what are we importing less. If I'm in manufacturing and I'm not able to import my machines or my raw materials because the dollar is so strong, that should be a cause of concern. Because that now ripples through the supply chain. And no wonder people are talking about reducing workers by 15%. But the bigger question we should be asking is, are we exporting more? If the deficit was reducing because we are exporting more, I would be very happy. In this forum area in the day, you showed some very interesting headline there, how the reserve price of tea is going down because we are stuck with what? With more tea. So I think we should look at it both sides. Are we exporting more? And what are we not importing? Because to me, that's not something to celebrate. As long as we are not exporting more, I'm not bothered about whether we are importing less.
The reason why I was talking of manufacturing stupid is when we talk of more exports, I think we can only, the value of the exports, we export, I guess, a lot of primary and processed goods, particularly the agricultural ones. How I wish that we would process even 50% of it so that we add value, so that we export premium goods rather than what we are doing mostly at the moment. So for me, really, the focus would be, for me, I have no problem government pumping 100 billion shillings into the agricultural sector, because the agricultural sector has the possibility of driving an entire ecosystem around it. And I was happy to hear that I think government's working on this agri-tech event coming up in April. The idea is, the moment we are doing value addition in agriculture well, you end up addressing issues of climate change, issues of health, say, for example, indigenous foods for wealth and health. So a whole lot of things could go around it. So for me, the focus is, how do we ensure that the cost of production is affordable? And how do we, I think Keproba needs to do a little more in this regard to promote export. How are we incentivizing our own small-scale mama mbogas, the micro-enterprises, the cottage industries, to export, to produce more and export more? So I think in this regard, although I know people have had divided opinions about the special economic zones or the industrial parks being established in the counties, in my view, if they could come up as centers of excellence for producing high-quality products which can be exported, I think it's the way to go. I fully support us focusing on improving production for export.
Indeed. All right, and we've seen tea, coffee, some of the things that also they are not really having some very good contribution when it comes to value addition. That has been also one of the key concerns, especially on this particular trade deficit as it stands right now. But we can see reforms in the coffee sector. They're talking about reforms in the coffee sector that is now bearing fruit as far as the coffee sector is concerned. The prices are going up, but the value addition still remains a problem. Can we circle back with that and we just look at to what will be happening on that particular front as well? But there's also some warnings that is coming from Moody right now. They're sounding a warning regarding the banks raising non-performing loans defaults, and we'll tell you more about that on the other side of the break. What does that really portend moving forward, despite the fact that we could see super normal profits from the banks, but still we have the non-performing loans. How is that going to adversely affect